What caused the Great Depression? Have you ever wondered what led to one of the most challenging economic times in history? The Great Depression, which lasted from 1929 to 1939, was a period marked by severe economic decline. It was not caused by a single event but rather a mix of factors that came together in a perfect storm. The first major event was the stock market crash in October 1929. During the Roaring Twenties, many people invested heavily in stocks, often borrowing money to do so. When stock prices began to drop, investors were unable to pay back their loans. This forced many to sell their stocks at a loss, leading to panic and further price declines. As the stock market collapsed, confidence in banks also took a hit. Many banks had invested customer deposits in the stock market or lent money to investors. When stock prices fell, banks faced massive losses. This situation led to bank runs, where people rushed to withdraw their savings. Between 1930 and 1933, around 20% of banks in the United States failed. This made it harder for people to get loans, which reduced spending and investment. Another factor was the contraction of the money supply. As banks failed, many people started hoarding cash. The Federal Reserve, which is the central bank of the United States, raised interest rates to maintain the gold standard. This decision did not help the economy. Instead, it led to deflation, where prices fell, making people less likely to spend money. The cycle of debt also played a significant role. Economist Irving Fisher described how falling prices increased the burden of debt. As prices dropped, it became harder for borrowers to repay loans. This led to more defaults and bankruptcies, worsening the financial crisis and causing further declines in jobs and income. Demand for goods and services also fell sharply. With people spending less, businesses struggled to stay afloat. Protectionist policies, such as the Smoot-Hawley Tariff Act, raised tariffs on imports. This led to retaliatory tariffs from other countries, causing international trade to plummet and deepening the economic slump. Initially, the government response was limited. Many believed that the economy would recover on its own. However, as time went on, it became clear that more intervention was needed. Later economic theories suggested that a lack of government spending contributed to the prolonged downturn. The Great Depression was a complex event caused by a mix of financial market collapse, banking failures, reduced money supply, and a decline in demand. These factors created a cycle of economic hardship that affected millions. Understanding these causes helps us see the importance of banking stability and government intervention in preventing future economic crises.